Hello, my friends, and welcome to Currency Archive. At our age, we've seen enough to know when something doesn't add up, haven't we? That's why I'd appreciate it if you take just a moment, click that subscribe button below. Think of it as keeping a trusted friend close, someone who will tell you the truth, not what sells, and tell me, where in the world are you watching from today? Drop your city or country in the comments. I'd love to know how far this message is reaching. Now, let's uncover what's really happening. Silver $91, gold $5 out of $50, 6T recovery in 48 hours, while China shut out. It's February 4th, 2026, and something terrifying just happened. $6 trillion added back to precious metals in just 48 hours. Gold jumped $700 per ounce from Monday's lows, silver up 26%. But here's the part they're not telling you. In China, bank apps crashed. Millions of people locked out, unable to buy gold even when they desperately wanted to. 5.9% of silver vanished from vaults. In one day, the price is recovering, but physical metal is disappearing faster than ever. What they don't want you to see is happening right now. And it's not about the price anymore, it's about something far more dangerous. Hello, my friends, and welcome to Currency Archive. At our age, we've seen enough to know when something doesn't add up, haven't we? That's why I'd appreciate it if you take just a moment, click that subscribe button below. Think of it as keeping a trusted friend close, someone who will tell you the truth, not what sells. And tell me, where in the world are you watching from today? Drop your city or country in the comments. I'd love to know how far this message is reaching. Now, let's uncover what's really happening. On the morning of February 4th, 2026, analysts across global financial centers opened their screens to a sight that defied conventional market behavior. Something extraordinary had occurred in precious metals markets during the previous 48 hours. The numbers told a story that seasoned traders found difficult to reconcile with their understanding of how commodity markets typically function. Gold had surged nearly $700 per ounce from its Monday lows. The yellow metal now traded at $5,050, representing a 15.62% recovery in just 2 days. Silver had performed even more dramatically, climbing 26% from its recent bottom to reach $91 per ounce. Together, these two metals had added approximately $6 trillion to their combined market capitalization in a time frame that would normally accommodate far smaller movements. For context, market observers noted that gold had gained $4.74 trillion in value, while silver had added $1 trillion. These were not typical fluctuations. They represented capital flows of a magnitude usually associated with major geopolitical events or central bank interventions. Yet no obvious catalyst appeared in the news cycle. No war had been declared. No currency had collapsed. No central bank had announced a dramatic policy shift. The recovery itself presented the first puzzle. Financial markets had witnessed precious metal rallies before. The 2008 financial crisis had driven gold higher over months. The 2020 pandemic uncertainty had created sustained buying pressure. Even the 2022 inflation surge had pushed metals upward in a measured fashion. But those movements had unfolded over weeks or months, not hours. They had followed predictable patterns of technical breakouts and fundamental reassessments. This recovery followed no such pattern. It was compressed, violent, and strangely divorced from the typical narrative that accompanies such moves. Market commentary struggled to explain what fundamental shift had occurred between Monday's lows and Wednesday's highs. The explanations offered seemed inadequate to the scale of the movement. Then, reports began emerging from China that added a second layer of complexity to the situation. Retail investors across Chinese cities were experiencing unprecedented difficulties accessing precious metal markets. Bank applications that normally facilitated gold purchases were crashing. System overload messages appeared on screens. Customer service lines were jammed with frustrated buyers, attempting to understand why they could not complete transactions. The timing was striking. As gold prices had dipped on Monday, Chinese retail investors had apparently rushed to buy what they perceived as a discount. This was rational behavior. Young Chinese buyers, increasingly skeptical of traditional financial instruments, had been shifting capital into tangible assets. Gold represented security in a world of digital promises and government-backed paper. But when these buyers attempted to act on their analysis, the infrastructure failed, applications froze, transactions timed out, settlement delays stretched from hours into days, and crucially, these technical difficulties occurred precisely when buying pressure was most intense. The systems worked adequately when prices were stable or rising. They failed when millions of users simultaneously attempted to buy a dip. Western markets experienced no such disruptions. Traders in London, New York, and Zurich executed orders without delay. The technological infrastructure supporting precious metal transactions in these markets handled the volume surge without incident. This created a geographic disparity that raised uncomfortable questions about whether access restrictions were truly technical in nature or something more deliberate. Market data revealed another troubling dimension to the recovery. While prices were rising rapidly on exchanges, physical metal was simultaneously disappearing from depositories. On Monday alone, COMEX silver vaults had reported withdrawals of 2 million ounces. This represented 5.9% of available inventory removed in a single day. The correlation was undeniable. As paper prices recovered, physical metal vanished. Historical analysis showed that commodity markets typically move in the opposite direction. When prices rise, supply usually increases as holders sell into strength. When prices fall, supply contracts as holders wait for better valuations. But in this instance, the traditional relationship appeared inverted. Rising prices correlated with contracting physical supply. The paper market said one thing, the physical market said another. This disconnect between paper and physical markets was not new to precious metals. Observers had documented such divergences before, but the scale and speed of this particular episode stood out. The premium between Shanghai spot prices and Western spot prices had widened to 14 per ounce for silver, representing a 16% geographic arbitrage. Shanghai spot traded at $104, while Western markets showed $90. Shanghai futures positioned at $101, creating a complex three-tier pricing structure that defied the concept of a single global market. For business leaders and institutional investors monitoring these developments, several questions demanded answers. Was this recovery sustainable, or merely a short-term liquidity event? Why had physical inventory contracted during a price surge? Why had Chinese retail investors been systematically locked out during the buying window? And most importantly, what did the combination of these factors signal about the underlying health of precious metal markets? While financial media celebrated the precious metals recovery, a quieter story was unfolding in the windowless warehouses that house the world's physical silver and gold. Data emerging from these depositories told a narrative that contradicted the optimism of rising prices. The vaults were emptying at an accelerating rate, and the pattern of withdrawals suggested something far more significant than routine market activity. COMEX depository reports for Monday, February 2nd, revealed an exodus that veteran metals traders found alarming. Precisely 2 million ounces of silver had been withdrawn from registered vaults in a single 24-hour period. To understand the significance, analysts calculated that this represented 5.9% of available inventory disappearing in one day. At this depletion rate, the entire registered silver stock would vanish in approximately 17 trading days. The withdrawals were not random. Asahi Refining had seen 35,000 ounces exit its facilities. Brink's registered vaults adjusted downward by 1.1 million ounces. HSBC reported outflows of 400,000 ounces. These were not small retail buyers collecting a few coins. These were institutional scale movements, indicating that large holders were converting paper claims into physical possession at an urgent pace. What made this pattern particularly noteworthy was its timing. Traditional commodity market theory suggests a simple relationship between price and supply. When prices fall, physical holders typically retain their metal, waiting for better valuations. When prices rise, holders sell into strength, adding supply to the market. This basic dynamic had governed commodity markets for centuries. Yet the current situation inverted this relationship entirely. On Monday, when silver prices hit their lows, withdrawals accelerated. On Tuesday, as prices began recovering, withdrawals continued at elevated rates. By Wednesday, with silver up 26% from its bottom, physical inventory was still contracting rather than expanding. The paper market and physical market were telling contradictory stories about supply and demand. Institutional analysts examining this divergence noted a troubling implication. If physical metal was leaving vaults during a price recovery, it suggested that large holders did not trust the paper market to maintain its correlation with physical reality. These withdrawals represented a vote of no confidence in the pricing mechanism itself. Holders were choosing possession over price exposure. Shanghai market data added another dimension to this puzzle. While Western spot prices showed silver at $90 per ounce, Shanghai spot prices reflected $104. This 14 premium represented a 16% geographic arbitrage that should not exist in a properly functioning global market. Shanghai futures contracts traded at $101, creating a three-tier pricing structure that defied the concept of market efficiency. Economic theory suggests that such price disparities cannot persist. Arbitrageurs should immediately buy in the cheaper market and sell in the expensive market, eliminating the spread. Yet the premium remained. This persistence indicated that arbitrage was either restricted or impossible. The metal that commanded $90 in New York could theoretically fetch $104 in Shanghai, but moving it between these markets was evidently not occurring at sufficient scale to close the gap. Settlement mechanisms provided a potential explanation for this failure of arbitrage. In precious metals markets, there exists a critical difference between buying a contract and taking delivery of physical metal. Futures contracts settle in cash far more frequently than they result in actual metal changing hands. Exchange-traded products often hold claims on metal rather than the metal itself. This structure works smoothly when participants trust that paper claims can be converted to physical metal on demand. But when that trust erodes, the system reveals its fragility. If buyers suspect that conversion from paper to physical might be delayed, restricted, or denied, the premium for immediate physical possession rises. The Shanghai premium suggested exactly this dynamic. Chinese buyers were willing to pay 16% above Western prices for the certainty of immediate physical delivery. Refinery data corroborated the supply chain stress. Global silver refining capacity operates on relatively thin margins during normal conditions. Refineries process mine output, recycled material, and industrial scrap into standardized bars that meet exchange delivery requirements. This process requires time, energy, and specialized equipment. Capacity cannot be instantly expanded to meet demand surges. Reports from major refineries indicated that order backlogs were extending. Lead times for delivery of newly refined silver bars had stretched from the typical 2 weeks to 4 or 5 weeks. Some refineries were selectively accepting orders, prioritizing long-term customers over new buyers. These were classic symptoms of a supply chain operating at maximum capacity with no surge availability. Transportation logistics added another constraint. Moving physical precious metals requires specialized security, insurance, and handling. The infrastructure supporting this movement operates at steady state volumes. When demand for a physical delivery spikes suddenly, the logistics chain cannot simply accelerate. Armored transport, vault capacity, and insurance coverage all have finite limits that cannot be exceeded without advanced planning. The combination of these factors created a situation where paper markets showed ample liquidity, while physical markets showed mounting strain. Traders could buy and sell futures contracts instantaneously in unlimited quantities, but converting those contracts into actual metal faced delays, premiums, and in some cases outright restrictions. The gap between paper promises and physical delivery was widening. For businesses holding precious metals as part of their treasury strategy, this divergence presented a critical decision point. Were their holdings genuine physical possession or paper claims on a stressed system? The difference, previously academic, was becoming operationally significant. Those holding actual metal in segregated storage faced no delivery risk. Those holding shares in metal-backed funds or futures contracts faced questions about whether conversion to physical would be honored promptly if demanded. The vault data revealed an uncomfortable reality. At the precise moment when prices were recovering and financial media was declaring the correction over, the physical metal underpinning the entire market structure was silently, steadily disappearing. In the gleaming financial districts of Shanghai, Shenzhen, and Beijing, a demographic shift was occurring that central planners had not anticipated. Young professionals in their 20s and 30s, the generation raised on digital payments and cryptocurrency promises, were making an unexpected pivot. They were buying gold, not digital gold, not gold-backed tokens, not shares in gold mining companies, physical metal that could be held, stored, and controlled without intermediaries. This was not the behavior that economic models had predicted. Younger generations were supposed to embrace technology, trust digital systems, and reject the archaic preference for tangible assets that characterized their parents' generation. Yet the data streaming from Chinese banks told a different story. Applications for physical gold purchase programs were surging among users under 40. The velocity of this capital movement had caught financial institutions unprepared. Interviews with these young buyers revealed a consistent theme. They spoke of uncertainty, not about economic growth or stock valuations, but about the permanence of digital claims themselves. One software engineer in Shanghai explained his reasoning with stark clarity. He had watched cryptocurrency exchanges freeze withdrawals. He had seen digital payment platforms restrict account access based on algorithmic flags. He had observed how quickly digital wealth could become inaccessible when systems decided, for whatever reason, to deny access. Gold offered something fundamentally different. It existed independent of networks, servers, and administrative permissions. A 1-ounce bar stored in a home safe required no application to access, no system verification to transport, and no third-party approval to sell. In an increasingly digital world where access depended on technological infrastructure and institutional cooperation, physical metal represented autonomy. This philosophical shift was translating into unprecedented demand volumes. Chinese banks had developed sophisticated gold investment products, designed to capture retail interest without requiring actual physical delivery. These products allowed customers to buy gold exposure through their banking applications, with the metal theoretically held in bank vaults on their behalf. The system worked efficiently when demand was steady and withdrawals were infrequent. But the events of February the 2nd through 4th revealed the limitations of this just-in-time approach. When tens of thousands of users simultaneously attempted to purchase gold during the Monday price dip, the bank applications buckled under the load. Error messages appeared on screens across the country. Transactions timed out mid-process. Customer service queues extended into hours-long waits. The infrastructure built to handle normal flow could not accommodate surge demand. What made this failure particularly significant was its timing. The systems functioned adequately when prices were stable or rising gradually. They experienced no difficulties when users were simply checking balances or reviewing holdings. But the moment that buying pressure intensified, precisely when users most needed access, the infrastructure failed. This pattern had occurred before in other markets, and observers noted the consistency. Access restrictions emerged at moments of peak demand. For Chinese authorities monitoring capital flows, this retail rush into precious metals represented a concerning trend. State policy had long encouraged citizens to invest in domestic equities, real estate, and government bonds. These investment channels kept capital circulating within the controlled financial system. Precious metals, particularly when held in physical form, represented capital leaving the conventional system. Metal, sitting in a private safe, generated no tax revenue, supported no domestic lending, and remained beyond the reach of monetary policy. The regulatory response had been subtle but consistent. While gold ownership was not prohibited, the mechanisms for purchasing and storing physical metal were deliberately constrained. Banks offered paper gold products more readily than actual delivery. Customs regulations made importing significant quantities of metal complex and expensive. Storage facilities required licensing and oversight. The system was designed to channel demand toward paper claims rather than physical possession. Yet the February surge demonstrated that when trust in paper claims eroded, these regulatory constraints could not prevent capital from seeking tangible alternatives. Users who could not access bank gold products began exploring secondary markets. Private dealers reported dramatic increases in inquiries. Jewelry shops that sold investment-grade gold bars experienced unexpected demand. The capital was finding alternative paths when primary channels were restricted. Western markets provided an instructive contrast. When precious metal prices dipped on Monday, American and European buyers accessed metal markets without systemic disruptions. Online dealers processed orders normally. Futures markets operated without interruption. The technological and logistical infrastructure supporting Western precious metals markets absorbed the demand surge without visible strain. This geographic disparity in market access raised questions about whether the Chinese difficulties were purely technical or reflected deeper systemic constraints. The age profile of Chinese precious metal buyers revealed another dimension of this trend. These were not elderly savers protecting retirement wealth. They were young professionals at the beginning of their wealth accumulation phase. Their asset allocation decisions would compound over decades. If this generation maintained a preference for tangible assets over digital claims, the implications for Chinese capital markets were profound. The next 30 years of savings flows could shift away from bank deposits and securities toward physical commodities. Economic researchers studying this behavioral shift noted historical parallels. Previous generations that experienced currency instability or financial system failures often maintained heightened demand for hard assets throughout their lifetimes. The hyperinflation that struck Germany in the 1920s shaped German savings behavior for decades afterward. The bank failures of the 1930s influenced American attitudes toward deposit insurance for generations. Formative financial experiences created lasting preferences. For China's young professionals, the formative experience was not hyperinflation or bank failures. It was digital control. They had observed how quickly access to digital wealth could be restricted through technological means. Social credit systems could limit financial access. Application permissions could be revoked algorithmically. Digital assets could vanish through platform failures or regulatory decisions. These observations were shaping a generation that valued assets beyond digital control. The demand surge for physical precious metals represented more than a short-term price reaction. It reflected a fundamental reassessment of what constituted reliable wealth storage. Paper claims required trust in institutions, regulations, and technological systems. Physical metal required only a safe and the discipline to maintain possession. For a generation that had watched digital promises prove unreliable, the choice was becoming clear. As bank applications remained overloaded and access to official gold purchasing channels stayed restricted, the message to Chinese retail investors was unambiguous. The system would accommodate their demand for precious metals only at the pace and scale that suited institutional convenience. When their demand exceeded that convenience, access would be denied regardless of their willingness to pay market prices. This realization was not creating panic, it was creating determination. The young professionals locked out of bank gold products on February 2nd were not abandoning their intention to buy precious metals. They were simply learning to navigate alternative channels. And with each failed login attempt, each transaction timeout, each system overload message, their preference for physical possession over institutional promises was reinforced. In the abstract realm where paper contracts meet physical reality, a mechanism exists that few outside specialized trading desks fully understand. This mechanism governs how prices are discovered, how supply appears abundant on screens while vanishing from vaults, and how access can be simultaneously guaranteed and denied. The events of February 2026 pulled back the curtain on this architecture, revealing a system built not for transparent price discovery, but for managed perception. Futures markets serve a legitimate economic function. Farmers can lock in crop prices before harvest. Airlines can hedge fuel costs months in advance. Manufacturers can stabilize input expenses through forward contracts. In theory, these markets allow risk transfer from those who cannot bear uncertainty to those willing to absorb it for a price. Precious metals. Futures markets claim to serve the same function, allowing miners, jewelers, and industrial users to manage price volatility. But the volume of paper contracts traded in precious metals markets bears little relationship to actual physical production or consumption. On any given day, the amount of gold and silver traded through futures exchanges exceeds global mine production by factors of 10 or 20. These contracts do not represent metal that exists or will exist. They represent betting positions on price movements, settled almost entirely in cash rather than physical delivery. This structure creates a peculiar dynamic. Price discovery occurs in the futures market, where unlimited paper contracts can be created through keystrokes. Physical metal, constrained by geology, refining capacity, and transportation logistics, must accept the price determined by this unlimited paper supply. The tail wags the dog. The infinite determines the price of the finite. When physical demand surges, while paper markets remain calm, the system experiences cognitive dissonance. Vault inventories decline while futures markets show no supply stress. Premiums emerge in physical markets while futures prices remain stable. Settlement delays extend while contracts continue trading seamlessly. These contradictions reveal the gap between the paper representation and physical reality. The February price recovery illustrated this mechanism in operation. On Monday, as prices reached their lows, physical buyers attempted to act. Chinese retail investors rushed to purchase gold through bank applications. Institutional buyers submitted orders for silver delivery from COMEX vaults. Dealers attempted to restock inventory from refineries. This was genuine demand for actual metal, not leveraged bets on price direction. The response from the system was instructive. Paper markets absorbed the demand temporarily, allowing futures prices to stabilize and begin recovering. But physical markets experienced friction at every level. Bank applications crashed. Vault withdrawals were processed but not replenished. Refinery backlogs extended. The paper market said supply was adequate. The physical market said supply was constrained. Historical examination of previous precious metal price movements revealed a consistent pattern. During periods of calm, paper and physical markets moved in lockstep. Premiums remained minimal. Delivery occurred without incident. The system functioned as advertised. But during periods of stress, when physical demand intensified, the correlation broke down. Physical premiums spiked, settlement delays appeared, access restrictions emerged under the label of technical difficulties. Market participants had developed terminology for this phenomenon. They spoke of force majeure clauses that allowed exchanges to settle contracts in cash if physical delivery became impractical. They referenced exchange for physical programs that encouraged contract holders to accept cash rather than metal. They noted position limits that prevented any single entity from demanding too much physical delivery. These mechanisms, presented as risk management tools, functioned collectively to discourage conversion of paper claims into actual metal. The business implications of this architecture were becoming impossible to ignore. Companies holding precious metals as treasury reserves faced a fundamental question about the nature of their holdings. Balance sheets listed gold and silver at current market values, but those values assumed the ability to sell at quoted prices. If the mechanism for converting holdings into cash involved delays, restrictions, or forced settlements at disadvantageous prices, the effective value might differ substantially from the stated value. Counterparty risk, traditionally associated with the creditworthiness of trading partners, now extended to the infrastructure itself. A company holding physical metal in its own vault faced no counterparty risk. A company holding shares in a metal-backed exchange-traded fund faced the risk that the fund might not hold the claimed metal or might face restrictions on selling it. A company holding futures contracts faced the risk of cash settlement rather than physical delivery. These risks were not equivalent, yet accounting standards often treated them as such. The access restriction pattern observed in China provided a case study in how physical scarcity could be managed without explicit prohibition. The government had not banned gold ownership. Banks had not refused to sell gold products. Applications had simply become unreliable during peak demand periods. This approach achieved restriction through inconvenience rather than regulation. No legal precedent was set. No rights were formally violated. Access was simply denied through technical means that could be attributed to system capacity rather than policy. Western markets prided themselves on superior infrastructure and transparent regulation. Yet the same fundamental tensions existed. Futures markets traded volumes far exceeding physical supply. Exchange-traded products claimed metal backing without publishing vault locations or serial numbers. Delivery delays during periods of high demand had occurred in London and New York, just as they had in Shanghai. The presentation was more sophisticated, but the underlying architecture shared common features. Portfolio managers examining these dynamics faced a strategic decision that extended beyond simple asset allocation. The question was not merely whether to hold precious metals, but in what form. Physical possession eliminated counterparty and system risk, but introduced storage costs and security concerns. Paper claims offered liquidity and convenience, but depended on the continued functioning of a system showing signs of strain. The choice reflected different assessments of where risk truly resided. Some analysts argued that the entire concern was overblown. Markets had experienced volatility before and always recovered. Technical difficulties were temporary inconveniences, not systemic failures. Premiums between physical and paper markets were normal features of any commodity landscape. The system had proven resilient through previous stress periods and would do so again. But other observers noted troubling differences in the current situation. The velocity of vault inventory depletion was unprecedented. The geographic price disparities were wider than historical norms. The access restrictions were occurring during a recovery rather than a crash. And most significantly, the demographic choosing physical over paper included young professionals who should theoretically have the highest trust in digital systems. The synthesis of these observations pointed toward a conclusion that challenged conventional market assumptions. The $6 trillion recovery in precious metals, market capitalization was real in the sense that contract prices had risen, but the underlying physical metal supporting those contracts was simultaneously vanishing from accessible storage. Price and availability were diverging. The system was providing price signals that did not reflect physical reality. For business leaders responsible for capital preservation, this divergence presented a warning that could not be dismissed as conspiracy theory or fringe concern. When systems restrict access precisely when demand peaks, when paper markets show abundance while physical inventories decline, when geographic premiums persist. Despite theoretical arbitrage opportunities, these are not coincidences. They are symptoms of a structure operating under stress. The architecture of modern precious metals markets was designed to provide liquidity and price discovery through paper contracts, backed by limited physical reserves. This design worked smoothly when trust remained high and conversion demand stayed low. But when that trust eroded and conversion demand surged, the architecture revealed its true nature. It was built not to deliver metal, but to deliver price information. When those two functions came into conflict, the system prioritized price stability over physical availability. The February 2026 events had demonstrated this priority structure with unmistakable clarity. Paper markets recovered smoothly while physical markets experienced friction. The question facing serious investors was whether this represented a temporary anomaly or a permanent feature of how precious metals markets would function under stress. The answer to that question would determine whether holdings in these markets represented genuine wealth preservation or exposure to a system whose promises exceeded its capacity to deliver.